Personal loans seem harmless until they silently crush your finances. The real danger? It depends on your age. Let me break it down. First, let's answer the question, why is personal loan debt worse than other types of debt? Interest rates, typically 10% to 25%. That's higher than a mortgage and sometimes even higher than credit cards. Terms, usually short, 2 to 5 years, which means higher monthly payments. It's unsecured, there's no asset backing it. Lenders take more risk, so they charge you more. Now, personal loans aren't always bad. If you're 18 to 25, your average personal loan balance might be around $5,000 to $10,000. That may not sound like much, but here's the danger. At 18% interest, that's $1,800 a year in just interest. On an entry-level salary of $35,000, that's 5% of your income. Gone. Your credit score gets impacted early, and that hurts your ability to get better loans later. Example, borrow $7,000 at 20% interest for 5 years, total repayment $11,000 plus. That's $4,000 more than you borrowed just for being young and impatient. At this age, every dollar wasted on high interest debt is a dollar not invested. If you put that same 200 month into the stock market instead, by age 35, you'd have 60K plus. That's the true opportunity cost. This is where personal loan debt becomes a life-altering mistake. Average loan balances here can be 15K, 20K. Most people are starting families, buying cars, saving for homes. Debt-to-income ratio is now under the microscope. Mortgage lenders look at this number closely. Example, 20K loan, 5 years, 15% interest, conquers $24,000 plus repayment. That's $400 a month, which could have been your down payment fund. 20K loan at age 55, 5 years, 10% interest, Versager 25K repayment. That 5K could have been invested for retirement. Over 10 years, that's 10K, 15K lost in growth. At this stage, personal loan debt doesn't just slow you down. It prevents retirement altogether. People end up working into their 70s not because they want to, but because they have to. So what's the actual threshold where personal loan debt ruins you? General rule, if your total debt payments, including personal loans, are more than 36% of your income, you're financially stuck. If personal loan debt alone is over 10% of your annual income, you're in the danger zone. The harsh truth? Many people in this age range delay buying homes, investing, or even switching jobs because their debt-to-income ratio is too high. Personal loan debt doesn't just hurt your wallet, it limits your life options. By midlife, personal loan debt isn't just about money, it's about stress. Average balances here can climb to 25K, 30K, often stacked on top of mortgages, car loans, and credit card balances. Example, 30K loan at 12% interest over 5 years, 40K plus repayment. That's 10K lost to interest. Personal loans are tricky. They promise quick solutions, but in reality, they silently eat away your future. The number that ruins you depends on your age, but the principle is the same. The less you owe, the freer you are. If you found this breakdown helpful, drop a comment with your age group and how much personal loan debt you think is too much. And if you want me to cover credit card debt or mortgage debt by age, subscribe, because that's coming next.